All right, hello everybody. It's Tim Denson here, sales manager at one of the Ford stores in Middle Georgia. Just going to go over something today, real simple, real fast, and real easy. Basically, the difference between going extended terms in a car loan and going short term. Now, going short term, and of course, this is not going to be the same for everybody. There's going to be different people in different situations. So, I mean, if you've got $1 zillion in the bank and you got an 800 credit score and you've got a debt to income of $100 a month, this is really not for you. I mean, it's not going to affect you. But if you're the average cat who, the credit's important, which you still got a good score, but you have a decent amount debt to income coming out of your credit already, going longer terms is something that's good for you. Now, shorter term would be always the best goal to go. Shorter term gets you title in hand faster. You pay less interest, and it puts you in an equitable position faster, and it puts you in a position to trade faster as well. So shorter term is the ideal goal if you're the non-average person with a low debt to income. Now, if you have a high debt to income, longer terms is what you want to do, because the bank, when it comes to a car loan, they're not looking at how much you finance, they're just looking at how much your payment is each month. So they take each of your payments, your house, your car, everything, they add that all up, and at the bottom of your credit report, they're going to see, well, he's got $2,000 coming out a month. All right, so now if you're getting a car loan, you're doing 36 months on the F-150, and your car loan's $1,500 at 36 months, now the bank's looking, he's got $3,500 a month coming out. Compared to if you say you go 84 months, 72 months, 75 months, your car loan's $800, now you have a $2,800 debt to income coming out at the bottom of your credit report. So that's another thing you can use also with your customers. So a customer, only wants to go 60 months. We got to explain to them, look, if it was me, I'd go 84 months and then just pay extra. They're simple interest loans, and everything you're going to pay extra, you just let your bank know you want it to go towards the principal. So instead of going 36 months at $1,000 a month, I'd rather go $500 a month at 84 months and then just pay the $1,000, because another $500 that I'm paying is going to go directly towards the principal. But if I need to finance something else, when the bank pulls my credit at the bottom, they're only going to see $2,500 a month coming out instead of $3,000 if I took the $1,000 payment over the $500 payment. So once again, if you're just the average Joe, got a close debt to income when you're trying to buy things, going longer terms is the best way to go, because, like I said, the bank looks at the bottom part of it to see how much money you're paying each month towards bills. So if I go 36 months and have a $1,000 payment, the bank's going to see $1,000 coming out every month, compared to, even if I can pay that $1,000, compared to if I go 84 months, I have $500 coming out every month. That's what the bank looks at, but then I still make the $1,000 payment, and $500 of it goes towards the principal. So when your customers are asking you, man, look, I only want to go 72 months. Well, explain to them, Mr. Customer, look, going them 84 months is just fine. You say it's Christmas time and you want to make the smaller payment just that month. 84 months, simple interest loan, you just make that payment. Now, the rest of the year, when you want to pay $1,000, you just paid $1,000 a month, and $500 of it you put just straight towards your principal. So when your customers are not wanting to go extended terms, explain to them the reason why it's a good thing. It's actually a good thing when it comes to debt to income to go longer terms than it is to go shorter terms. Once again, that's not for everybody. That's just for people who, just the average Joe like myself, who has a decent debt to income level, good credit, wants to finance other things in the future, and when the bank pulls my credit report, I want to make sure my DTI is not that bad. So it's a good thing to go over with your customers. It's just a little car selling 101. My point of view, I mean, other people might disagree, might not be the right point of view. There might be people out there way smarter than me that know a whole lot more than me, but that's just my point of view on this matter. That when it comes to financing a car, I always try to go the longest term possible and then pay extra every month as well, just so the bank sees that, hey, man, this guy only has a $500 car payment. I'd rather the bank see me with a $500 car payment than the bank see me with a $1,000 car payment, even if I'm going to pay $1,000 a month. In the bank's mind, I want them to see, wow, this guy's only paying $500 a month. So hope that helps out. Like it below, share it. I'll take questions or comments, and more to come.